Something happened 3 days ago that most people completely missed. While you were going about your day, while the talking heads on television were discussing everything except what truly matters, a number appeared on official commodity exchange records that should send a chill down the spine of anyone paying attention. On February 11th, 2026, the amount of silver actually available for delivery at the COMEX fell beneath a barrier that analysts have been watching for years. We are now sitting below 100 million ounces in the registered category. If you understand what that means, you already know why this matters. If you don't, stay with me, because what I am about to explain affects your purchasing power, your savings, and the very foundation of how commodity markets are supposed to function. Before we go any further, if you are someone who values straight talk about markets, real data over headlines, and clarity in a world full of noise, go ahead and subscribe to Element Axis right now. This is where we break down what is actually happening beneath the surface of financial markets, not what they want you to believe is happening. Hit that subscribe button, turn on notifications, because what we are seeing unfold in the silver market is not going to wait for anyone to catch up. The data is moving fast, and if you want to understand what comes next, you need to be here when we release the next update. Now let me explain what just happened and why the number 100 million ounces is not just another statistic. The COMEX operates with two distinct categories of silver inventory. There is registered silver and there is eligible silver. Registered silver is metal that has been warranted by the exchange and is available to be delivered against futures contracts. When someone who holds a futures contract decides they want actual physical metal, instead of just rolling their position forward or settling in cash, they receive registered silver. That is the metal that backs up the paper promises. Eligible silver, on the other hand, sits in approved vaults and meets all the exchange specifications, but it is not designated for delivery unless the owner decides to make it available. Think of eligible as metal that is stored at the exchange, but not committed to the pool that can be handed over to settle contracts. Here is what makes February 11th significant. On that single day, the registered category saw a negative adjustment of more than 3.2 million ounces. At the same time, over 4.7 million ounces walked out of the eligible category. That means in one 24-hour period, the system lost 4.7 million ounces total. Not over a week, not gradually through the month, in one day. And that drop pushed registered silver down to just over 98 million ounces, breaking through the 100 million threshold for what appears to be the first time in this market cycle. This is not routine movement. This is not normal inventory management. This is acceleration, and it is telling us something that the price you see flashing on your screen is not. Now, why does 100 million ounces matter so much? The math is simple, and it is alarming. Every COMEX silver futures contract represents 5,000 ounces of metal. At any given time, open interest on COMEX silver futures regularly sits above 60,000 contracts. Do the arithmetic, that is 300 million ounces worth of paper claims. But there are now only 98 million ounces of registered metal actually available to deliver. The coverage ratio is worse than 3 to 1. For every ounce of physical silver that can be handed over, there are more than 3 ounces of paper claims floating around. You might be thinking, well, most futures contracts never go to delivery anyway. People roll them forward or settle in cash. The system has always worked this way, and you would be correct historically. The vast majority of futures traders never actually want the physical metal. They are speculating on price movements or hedging exposure. But here's the part that matters. The entire system only functions because participants believe that if they wanted to take delivery, they could. Confidence is the foundation. The second that confidence cracks, the second traders start to genuinely question whether there is enough metal to back the contracts they are holding. Behavior changes. And we are watching behavior change in real time. We are seeing sustained withdrawals week after week. We are seeing delivery demands that are not rolling over as smoothly as they used to. We are seeing premiums in physical markets that suggest buyers do not trust the paper prices they are being quoted. Drop a comment right now and tell me how you see this playing out. Do you think we are headed toward a delivery crisis? Or will the exchange find a way to manage through this like they have in the past? I want to hear what you think. Because this community has some sharp minds, and your perspective adds value to the conversation for everyone watching. Let me connect another piece of this puzzle, because what is happening at the COMEX does not exist in isolation. Right now in Shanghai, physical silver is trading at a premium of roughly $10 per ounce above the spot price you see quoted in New York or London. $10. Think about what that represents. If market mechanisms were functioning normally, that kind of spread should not exist. Arbitrage traders should be buying silver cheap in the West, shipping it to Shanghai, and selling it at the higher price. That process should continue until prices converge, but the premium has not compressed. In fact, at times it has widened. That tells you the arbitrage pathway is broken or severely restricted. You cannot move physical metal across borders as easily as you can move electrons representing paper contracts. There are capital controls, shipping logistics, regulatory barriers, and those barriers have created what is effectively a two-tier market. The West has a price determined by derivatives trading on exchanges. The East has a price determined by people and companies who actually need real metal for industrial use or investment. This divergence is information. It is the market screaming that something is disconnected. Paper says silver is worth one number. Physical demand in Asia says it is worth $10 more. That gap is not noise, it is signal. And the fact that this premium has persisted for weeks now, that it has not been arbitraged away, tells you that the physical metal is not flowing from west to east, the way textbook economics says it should. There are bottlenecks. There are constraints. There are barriers that prevent the market from equilibrating the way it is supposed to. And while that is happening, India just absorbed 40 million ounces of silver into exchange-traded funds over a 2-month window. 40 million ounces. That is nearly half of what the COMEX currently has in registered inventory, flowing into Indian investment products in just 60 days. This is not speculative money chasing a quick trade. This is structural accumulation. Indian investors are buying physical silver and financial products, backed by physical silver at a pace that would have seemed impossible just a few years ago. Think about what that represents in terms of demand. India has a massive population with a cultural affinity for precious metals. When that demographic starts allocating capital into silver at this scale, it creates a demand profile that is not going to reverse on a whim. This is not hot money that will flee at the first sign of volatility. This is patient capital seeking hard assets. At the same time, the Shanghai Futures Exchange is tightening the rules. Starting March 1st, they are implementing stricter hedging quotas. If you want to hold a position on the HFV, you are going to need to demonstrate that you have legitimate physical business justification. You cannot just show up as a speculator anymore. The exchange is explicitly prioritizing industrial users and hedgers over speculative capital. Why would they do that? Because warehouse stockpiles are at decade lows, and they are managing the reality that physical supply cannot meet both industrial demand and investment demand at current price levels. They are rationing access. They are making sure the metal that exists goes to the people who actually need it for productive purposes, not to traders who are just betting on price movements. Notice the pattern. 2 major exchanges, one in the United States and one in China, are both dealing with the same core problem. There is not enough physical silver to satisfy the combination of industrial consumption and investment demand. Their approaches differ, but the underlying issue is identical. The COMEX allows fractional coverage and hopes delivery pressure stays manageable. The SHFE changes the rules to restrict access and make sure physical users get priority. Neither response creates more silver. Neither solves the supply problem. They are managing symptoms, trying to keep the system functional while the fundamentals deteriorate underneath. If you are finding this breakdown valuable, do me a favor and hit that like button. It helps this content reach more people who need to see it. And it tells me this is the kind of analysis you want more of. And if you have not shared this video yet, send it to someone who is positioned in precious metals or thinking about it. This is the kind of information that does not show up in mainstream coverage. And the people who understand what is happening right now are the ones who took the time to look at the actual data. Let me give you some context on where the price stands, because the technical picture matters. Silver closed last week at just under $32 per ounce on the front month contract, up about 1.5% for the week. That snapped a 2-week losing streak and marked the largest 1-week percentage gain in a couple of weeks. Here is the broader view. Silver is currently down about 32% from its 52-week high of nearly $44, which it hit back in late January. But at the same time, it is up 167% from its 52-week low of just over $11 hit last April. Let those numbers settle in. Up 167% from the low, still 32% below the high. That tells you 2 things. First, the move has been massive for anyone who got positioned early. Second, there is potentially significant room to run if silver retests or exceeds that recent high. Year to date, silver is up about 11%. Month to date, it is down slightly. The pullback after the January spike is normal. Markets do not move in straight lines. They advance, consolidate, pull back, and then advance again. The question is whether the underlying structure remains intact for another leg higher. And based on what we are seeing in the physical market, the inventory data, the premium data, the exchange rule changes, the answer appears to be yes. Despite the volatility, despite the drawdowns, silver has been up 11 of the past 15 weeks. That is a trend. That is not random noise. That is consistent upward pressure despite all the attempts to contain it. There is a framework that some analysts use when thinking about bull markets and commodities, and it is worth considering. The idea is that historically, about 90% of a bull market's total gains occur in the final 10% of its duration. Read that again. 90% of the move happens in the last 10% of the time. If that pattern holds, and if silver is genuinely in a long-term bull market, the most explosive phase is still ahead. The run from $11 to $44 was dramatic. But if we are only midway through the cycle, the final acceleration could make what we have already seen look modest. Think about what that means. If the framework is correct, the gains we have witnessed so far, as impressive as they are, might represent only a fraction of what is coming in the final phase. That is the nature of parabolic moves. They look impossible until they happen, and then they look obvious in hindsight. Now, let me explain a technical development that is going to reshape how the futures market operates moving forward. The CME Group recently shifted margin requirements to a percentage-based system tied to the notional value of contracts. This is a significant structural change. Under the new system, as silver prices rise, the margin you are required to post automatically increases. If silver moves from $32 to $50, your margin requirement goes up proportionally. If it moves from $50 to $75, margin goes up again. What does this mean in practice? It means that leveraged speculators face higher capital demands during rallies. The higher silver climbs, the more expensive it becomes to hold leveraged long positions. This creates a natural brake on rapid price acceleration. It also shakes out weak hands who cannot meet margin calls during volatile moves. There are two ways to interpret this change. The bearish view says higher margins will prevent silver from spiking as aggressively as it might otherwise. Every rally triggers margin increases that force some participants to liquidate, creating selling pressure that caps the upside. The bullish view says higher margins improve the quality of the participants. Weak, over-leveraged speculators get washed out. Strong hands with real capital stay in. The remaining long positions are better capitalized and less likely to panic sell on pullbacks. The rallies may be slower, but they are more sustainable. Both interpretations have merit. What is clear is that the structure of the market is evolving, and understanding these changes is critical to navigating effectively. Over time, this shift may push the system toward more cash-backed participation rather than highly leveraged speculation. That reduces systemic risk, but it also changes the character of price movements. Let me lay out the bearish case because you need both sides to make informed decisions. Silver is still 32% below its record high. That is significant technical damage that has not been repaired. The charts show overhead resistance that has not been decisively reclaimed. The COMEX has managed situations like this before. They have tools, they can apply pressure for cash settlement. They can offer deals to participants willing to roll their contracts forward instead of taking delivery. They can implement regulatory changes if delivery pressure becomes unmanageable. The 3-to-1 coverage ratio is concerning, but it is not unprecedented. The system has operated with fractional backing for decades. The Shanghai hedging quotas might reduce speculative demand and ease some pressure on warehouse inventories. If Indian inflows slow down, that removes a major source of demand. If industrial consumption weakens due to economic slowdown, silver loses part of its fundamental bid. The dollar could strengthen if the Federal Reserve maintains a hawkish stance, which typically pressures precious metals, and banks still hold concentrated short positions that can be deployed to cap rallies when momentum threatens to accelerate. These are real risks, and anyone with exposure needs to account for them. That is the risk side. Those factors are real, and position sizing matters regardless of how bullish your long-term outlook might be. But here is the counter-argument. Registered silver below 100 million ounces is a threshold event. It is not speculation. It is in the official exchange data. Anyone can verify it. The 4.7 million ounces that left the system in a single day shows acceleration, not stabilization. The $10 Shanghai premium is not closing. It is persisting and at times expanding. That divergence represents real information about supply and demand that paper prices are not capturing. The 40 million ounces flowing into Indian funds in 2 months is not speculative froth. It is structural demand from a massive population seeking hard assets. Central banks continue buying gold at record pace. While we focus on silver, gold is showing you what institutional players think about the broader monetary system. They are accumulating metal, not paper. Silver being up 167% from its low shows the underlying trend remains powerfully bullish despite volatility. The path is not smooth, but the direction is clear. The fact that silver has been up 11 of the past 15 weeks, despite all the headwinds, despite the margin changes, despite the volatility, tells you there is genuine underlying demand supporting this market. The rule changes at the Shanghai Futures Exchange prove the exchange itself acknowledges physical tightness. You do not restrict delivery and hedging access if supply is adequate. The intervention confirms the problem. The CME margin changes push the market toward better capitalized participants. Weak hands get shaken out. Strong hands remain. The quality of the participant base improves. And if the framework about bull markets is accurate, if 90% of gains truly come in the final 10% of duration, And if we are only midway through this cycle, the most explosive phase is still in front of us. Before you go, drop a comment and tell me how you hold your silver. Are you in paper products like ETFs and futures, or do you own physical metal in your possession or allocated storage? I'm genuinely curious about the composition of this community because people who hold physical tend to view these inventory drawdowns very differently than people who hold paper. Both perspectives are valuable for understanding how this market might move. Here's what I want you to watch in the coming days and weeks. First, watch the COMEX registered silver levels. We broke below 100 million. Does it stabilize here? Does it bounce back above, or does the drainage continue? The direction of inventory will tell you whether February 11th was a one-time event or the beginning of something bigger. Second, watch the Shanghai premium. $10 is extraordinary. If it compresses, that suggests either more supply flowing east or reduced demand. If it persists or expands, the physical paper divergence is intensifying. Third, watch the March 1st implementation of the SHFE rule changes. How does the market respond? Does it reduce speculative activity? Does it create more dislocations? The transition will be informative. Fourth, watch Indian fund flows. 40 million ounces in 2 months is dramatic. Does that pace continue, accelerate, or slow down? Indian demand has become a major force. Fifth, watch silver's price action relative to key technical levels. Is it holding support or breaking down? Price above resistance with conviction is constructive. Price below support with follow-through is cautionary. Sixth, watch the March delivery month on the COMEX. How many contracts stand for delivery? How many roll forward? How many settle in cash? The delivery data will show you how serious the pressure really is. Seventh, watch gold. Gold tends to lead silver. If gold breaks out convincingly, silver historically follows with leverage. If gold fails, silver typically underperforms. And finally, watch the dollar index. Precious metals remain inversely correlated to dollar strength. Fed policy, economic data, and currency flows all factor into that relationship. This is not about predicting what happens tomorrow or next week. This is about identifying the data points that matter and watching how they evolve. The people who track this information systematically see patterns before they become obvious to everyone else. They understand when inventory drawdowns become unsustainable. They recognize when premiums signal a breakdown between physical and paper markets. They know the difference between normal volatility and structural change. And we are in a period of structural change. The data makes that clear. COMEX below 100 million registered ounces. Shanghai premiums at $10. Indian funds absorbing 40 million ounces in 2 months. The SHFE restricting delivery access. The CME changing margin structures. Each piece individually might be dismissible. Together, they paint a picture of a market under stress. The paper system that has controlled precious metals pricing for decades is showing cracks. Physical demand is overwhelming the infrastructure designed to manage it. Eastern markets are commanding premiums that Western paper cannot close. Inventories are depleting faster than they can be replenished. Rules are changing because the old rules do not work anymore. I am not going to tell you what to do with this information. That is your decision based on your circumstances, your risk tolerance, and your financial situation. What I will tell you is that the data is public, the trends are observable, the official exchange statistics, the premium calculations, the fund flow data, all of it is accessible to anyone willing to do the work. The people who do that work see what is happening. They understand why sub 100 million registered ounces matters. They know what a $10 Shanghai premium signals. They recognize the pattern when exchanges change delivery rules and margin structures at the same time. They see the math of 3-to-1 paper to physical and understand why that cannot persist indefinitely. Physical always wins in the end. You cannot run industrial processes on futures contracts. You cannot fabricate electronics with paper promises. You cannot manufacture solar panels or medical devices or electrical components with derivative positions. At some point, the metal has to be there, or the system recalibrates to reflect its absence. That recalibration may be gradual, or it may be sudden, but it is coming. The data we covered today tells you it is coming. Every withdrawal, every premium expansion, every rule change is the market adjusting to a reality that the official price has not fully acknowledged yet. But reality always wins. Physics always wins. You cannot deliver what does not exist, no matter how many paper contracts say otherwise. Stay focused, stay informed, verify the data yourself. Do not take my word for anything. Check the COMEX depository reports, check the Shanghai fixing prices, check the Indian fund holdings. The information is there for anyone who looks. This is not hidden. This is not secret. This is public data that most people simply do not take the time to examine. But when you do examine it, when you connect the pieces, the picture becomes clear. If this breakdown helped you understand what the sub 100 million threshold means and why the physical silver market is tightening, share this video with someone who needs to see it. Make sure you are subscribed to Element Access if you have not already, and turn on notifications so you do not miss the next update. Comment below and tell me what you think about this threshold. Is this the start of a delivery crisis, or will the COMEX manage through it like they have before? I want to hear your perspective. And tell me how you are positioned. Physical, paper, both, or sitting on the sidelines waiting. There is no wrong answer, only informed decisions and uninformed decisions. The point of this channel is to make sure you have the information you need to decide for yourself. The market will tell us what comes next. Our job is to watch, to observe, to let price action and physical flows confirm or deny what the data is suggesting. And right now, the data is confirming tightening. Whether that translates to higher prices tomorrow, next month, or next year is something the market will reveal in its own time. But the direction is clear. The inventory is depleting, the premiums are expanding, the rules are changing, and 100 million ounces of registered silver is now behind us.